Welcome to The Explainer. Have you ever wondered how an entire country, keeps its finances straight with the rest of the world? Well, today, we're going to build a nation's balance sheet right from the ground up, from a single shipment of goods all the way to a massive international loan. Let's get into it.
So, how does a country balance its books with everyone else? I mean, every single day, billions of dollars are zipping across borders for everything imaginable: cars, coffee, investments, even foreign aid. How does anyone possibly track all of that to figure out if a country is actually ahead or falling behind financially?
Well, believe it or not, there's an official system for this whole thing. It's called the balance of payments. The best way to think about it is like the ultimate financial statement for a country. Its job is to track every single dollar that comes in and every single dollar that goes out. So let's break down exactly how it works.
Okay, we're going to start with the part that's probably most familiar to all of us, the commercial balance. And it's pretty much exactly what it sounds like. It just tracks all the goods and services a country buys from and sells to the rest of the world. It's basically the nation's international shopping list.
Now, before we get to any numbers, we have got to get two key terms straight. On one side of the ledger, you have credits. That's any transaction that brings money into the country. Just think of it as income. And on the other side, you have debits. That's any money leaving the country. Think of those as expenses. Simple, right? Every single transaction from here on out will be one of these two.
So let's plug in some simple numbers to see how this works. Let's say our country exports $100 million worth of stuff. That's money coming in, so it's a credit. But at the same time, the country imports $150 million worth of products from other places. That's money going out, a debit. So after all that buying and selling, where does that leave us?
We are in the red. $50 million in the red, to be exact. The country spent more on things from abroad than it earned by selling its own things. And this negative number has a specific name. It's a commercial deficit. It just means that when you only look at trade, more money left the country than came in. But is that the whole story? Oh, not even close.
You see, trade is just one piece of this puzzle. To really get the bigger picture, we need to zoom out a little to what's called the current account.
So what about all the money that moves between countries that isn't for a product or a service? Think about things like foreign aid or donations from charities or even money that people working abroad send back home to their families. These are called unilateral transfers, and trust me, they can have a huge impact on the final balance.
Let's look at some real-world examples to make this clear. When the U.S. provides aid to Israel, that's a credit for Israel. Dollars are flowing in. But when Israel provides aid to, say, build a hospital in Ukraine or sends a relief mission to Turkey after an earthquake, that's a debit for Israel. Dollars are flowing out.
Okay, so let's add these grants and aid figures to our balance sheet. Let's imagine our country received a whopping $250 million in grants, but only gave away about $20 million in aid. We just add those right on top of our trade numbers, and all of a sudden, the total income is $350 million, and the total expenses are $170 million. Wow, the picture has completely flipped.
And just like that, we're not in a deficit anymore. After we account for all that aid, our country now has what's called a current account surplus of $180 million. But hold on, we are not done yet. There's still one more major piece to this puzzle. All right, now we move to the financial account. This is where we track all the money that's flowing across borders for investment purposes. We're talking about buying stocks, real estate, or even making and repaying big loans.
Let's walk through the numbers here. So, for money coming in, we had foreigners buy $50 million in local stocks and $100 million in real estate. Plus, the government took out a $300 million loan. Add that all up, and you get $450 million in credits. But look at the money going out. Our own citizens bought $500 million in foreign stocks, and our government paid back an old $500 million loan. That is a full $1 billion going out the door.
So when you look at just the financial world, our country has a massive deficit of $550 million. Way more money left the country for investments and loan payments than came in. All right, this is the moment of truth. We have our current account balance and we have our financial account balance. It's time to put it all together and see where our nation really stands with the rest of the world. Now, the calculation itself is actually pretty simple. You just take the balance of the current account and you add the balance of the financial account. But there's a really common trap here that's super easy to fall into. Here's the crucial thing to remember. You never add the commercial balance separately at the end. And why not? Because, remember, it's already included inside the current account. If we added it again, we'd be counting that initial trade deficit twice, and that would mess up the whole thing. Okay, here they are, our two key numbers. A surplus of $180 million from the current account and a deficit of $550 million from the financial account. Let's add them together and get our grand total. And the final result is an overall deficit of $370 million. When you account for absolutely everything, all the buying, the selling, the aid, the investing, our country sent $370 million more out into the world than it took in. Now, this isn't just some abstract number on a spreadsheet. This is a real shortfall. A country can't just end the year with a negative balance, right? It actually needs to find $370 million from somewhere to make its books balance. So where does that money come from? This is where a nation's emergency fund comes into play. It's foreign currency reserves. The easiest way to think about this is like a giant savings account that the central bank holds, and it's filled with other currencies, like US dollars or euros. Its main job is to cover shortfalls, exactly like the one we have right now. And this right here is the final step that makes everything balance out perfectly to zero. The central bank just dips into those reserves and uses $370 million to cover that deficit. The books are now officially balanced, but it came at a price. The nation's savings account just got smaller.
And that leads us to the really critical question, doesn't it? I mean, balancing the books one time by using your savings, that's fine. But what happens to a country's economy, to its currency, to its standing in the world, if it has to do this year after year after year, just watching that emergency fund slowly drain away? That, right there, is the real story behind the balance of payments.
Today, we're going to do more than just talk about economics. We're actually going to solve a puzzle, and we're going to use real numbers from Israel's economy in 2022 to do it.
Okay, let's dive right in. What you see here are 7 major financial events that happened in a single year. You can think of them as puzzle pieces. Our job is to figure out how to arrange these pieces to tell the story of a nation's economy.
So you're looking at all this, right? Exports, loans, real estate. Where do you even begin to make sense of it all? Well, to solve any puzzle, you need the right tool.
And that tool is called the balance of payments. It's basically a country's official scorecard for every single financial transaction it has with the rest of the world.
The simplest way to think about it is like a country's bank statement with the whole world. Seriously, money coming in is a credit, like a deposit, and money going out is a debit, like a withdrawal. That's it.
Now, what's really interesting is how we organize all these flows of money. We split them into 2 main buckets: the current account, which is for day-to-day stuff like trade, and the financial account, which is for bigger investments. So let's build this thing out transaction by transaction and put each piece where it belongs.
All right, let's start slotting these in. The government grant and the exports, that's money coming into the country, so that's a credit in the current account. Imports are also in the current account, but that's money flowing out, so it's a debit. Now, things like repaying a loan or buying stocks and real estate in another country, those are long-term investments, so they go into the financial account, and since the money is leaving Israel, they're all debits.
But hold on a second. What about that last item? An Israeli bank paying interest to Israeli investors. This is a classic misdirection you see in problems like this. It's a huge amount of money, but where does it fit in our puzzle? And here is the absolute #1 rule you have to remember. Because this transaction happened completely inside Israel, between 2 Israeli parties, it doesn't belong on the balance of payments at all. It's not money flowing in or out of the country. It's a distractor, a red herring, just to make sure we're paying attention. Okay, now that we've tossed out that trick piece, we can finally get to the answer. With all the real international transactions in place, it's time to do the math.
So first we add up all the credits, all the money that came into Israel. That comes out to $1.4 billion. Then we add up all the debits, all the money that left Israel, and that total is $1.86 billion.
So, what's the bottom line? Well, you take the money in and you subtract the money out, and you get this number. Negative $460 million. And that is the solution to our puzzle.
So what does a negative number here actually mean? It means the country spent more foreign money than it brought in. That's what we call a balance of payments deficit. And just like if you spend more than you make in a month, you have to dip into your savings, right? A country does the same thing. To cover that shortfall, Israel had to dip into its savings of foreign currency, which means its reserves went down by $460 million that year.
Okay, great. We solved the puzzle, we got the number, but why should anyone care? Why does this actually matter to a normal person? Well, it all connects to one of the most powerful forces in the entire economy, the exchange rate.
And this right here, this shows a fundamental economic tug-of-war. Think about it. When the dollar is strong, meaning it's worth more shekels, Israeli exporters are thrilled. $1 million sale overseas suddenly brings in way more shekels back home. But for importers and regular consumers, it's bad news. All that stuff we buy from other countries, cars, phones, clothes, it all just got more expensive. It's this constant balancing act.
And this doesn't just happen in a vacuum. It kicks off this powerful chain reaction, like a set of dominoes falling through the whole economy. A higher dollar exchange rate makes exporting more profitable. So what do those profitable companies do? They expand. They grow. And to grow, they have to hire more people. And more people getting hired means, eventually, the entire country's unemployment rate can go down.
Now, because this connection is so incredibly important, you can bet that most countries don't just sit back and hope for the best. Oh no, they have a strategy. Israel's strategy is something called a managed float. The idea is to kickstart that exact chain reaction we just saw. So, the Bank of Israel doesn't just watch from the sidelines, it actively jumps into the market and buys up billions of US dollars. All this buying creates artificial demand, which pushes the dollar's value higher and gives that all-important boost to the nation's exporters.
So what's the long-term result of this managed float policy? Well, look at this number. Over the decades, Israel has built up a massive war chest of foreign currency reserves. We're talking about $220 billion. This isn't an accident. It's the financial firepower they've built up from years of strategically managing their currency.
And that brings us right back to where we started, with a puzzle. That $460 million deficit we calculated seems pretty small now, but we can see it's part of a much bigger, much more delicate picture. A country can manage its currency to boost jobs, which is great, but the trade-off is that it often makes things more expensive for its own citizens. So that leaves us with a final, pretty provocative question for you to think about. How much control is too much, and who gets to decide on the right balance?
Welcome. Today, we are going to do something pretty cool. We're going to crack open a nation's wallet and see exactly how the money flows. We're talking every dollar, every euro, every yen that moves in and out of a country to really understand one of the most important scorecards in all of economics. I mean, just stop and think about it for a second. Every single day, you've got millions of transactions crossing borders. We're buying cars from Japan, software from the US, tourists are spending money all over Europe, and investors are snapping up property in London. How on earth does anyone keep track of all that? Well, the starting point, the place where we begin to unravel this whole thing, is a country's total economic output, what we call GDP. And a huge part of that calculation is figuring out what a country sells to the world, its exports, and what it buys from the world, its imports. That relationship is really our gateway to understanding this global flow of money. And the official tool that does all this tracking, it's called the balance of payments. The best way to think of it is as a country's official financial scorecard with the rest of the world. It's basically one giant comprehensive statement of all the money that flowed in and all the money that flowed out. Now, at its core, this big, fancy report is just a simple accounting ledger. Seriously, it has two columns: credits for any transaction that brings money into the country, and debits for any transaction that sends money out. That's it. Every single international transaction you can think of will fall into one of these two buckets. So let's break down how that actually works. All right, so the first major part of this report is what's called the current account. And this part is all about the day-to-day, short-term stuff. You know, the easiest way to wrap your head around this is to just compare it to your own personal finances. Think about it. Your paycheck is your income, right? And then you've got your expenses, groceries, rent, going out. The current account is doing the exact same thing, just for an entire nation. Okay, so the biggest piece of the current account is the trade of goods and services. And this part is super straightforward. When our country sells something to another country, an export, money comes in. So we log that as a credit. And when we buy something from another country, an import, money goes out. That gets logged as a debit. Simple. Let's just throw some numbers in here to see it in action. Let's imagine in 1 year, our country exports $100 million worth of stuff. That's a credit of 100. And let's say we import $90 million worth. That's a debit of 90. So here's the crucial part. We just subtract the debits from the credits. 100 minus 90 leaves us with a positive 10. This is what we call a trade surplus. It just means we earned more from selling our stuff to the world than we spent on buying their stuff. And of course, if that number were negative, we'd call it a trade deficit. And by the way, it's not just about buying and selling things. Stuff like foreign aid also gets tracked here. So if our country gets a grant from another nation, that's money coming in, a credit. And if we give aid to someone else, that's money going out, a debit. Okay, so that covers the day-to-day money flow. But now let's look at the second major part of our report, the financial account. This is where we get into the big, long-term investments. The analogy here is perfect. If the current account was like our country's monthly budget, the financial account is like our national investment portfolio. This is where we track all the buying and selling of financial assets. We're talking stocks, bonds, factories, real estate, the whole shebang. So how does this one work? Well, when a foreign investor buys property or stocks here in our country, money flows in. We call that an inward capital movement, and you guessed it, it's a credit. And on the flip side, when one of our citizens buys stock in a foreign company, money flows out. That's an outward capital movement, and it's a debit. Let's go back to our running example and add this in. Let's say foreigners invested $200 million in our economy this year. That's a credit. And maybe our own investors sent $300 million abroad to buy up foreign assets. That's a debit. But wait a minute. Let's do the math here. On the credit side, the money inside, we've got 100 from exports plus 200 from foreign investment for a total of 300. Now on the debit side, the money outside, we've got 90 for imports plus 300 for our investments abroad, which is 390. The books don't balance. We've got more money going out than coming in. So what happens now? This is my favorite part. This is where the real magic of macroeconomic accounting comes in, because there is one final, really critical piece to this whole puzzle that makes everything balance out perfectly. Let me introduce you to the secret ingredient, foreign currency reserves. You can think of this as a giant national savings account, but one that's full of foreign money. Dollars, euros, yen, you name it. It's held by the country's central bank, and its number one job in this context is to be the ultimate balancing item. And this is just brilliant. Check out how this works. We had a shortfall of 90, right? So to cover that difference, the central bank simply sells 90 from its stash of foreign currency reserves. That sale is counted as a credit. It's money coming into the domestic economy. So we add that 90 to the credit side, and voila, both sides now total 390. It's amazing. By definition, the balance of payments always balances to zero. Okay, I get it. That was a lot of accounting. But this isn't just some numbers game for economists to play. So why should you, or me, or anyone actually care about this report? Because the balance of payments is like a nation's financial health report card. It tells the entire world if a country is, living within its means. A big, persistent deficit could make your currency weaker, which makes all the stuff you buy from other countries more expensive. It signals to investors whether an economy is a safe bet or a risky one. It can even force a government to completely change its economic policy. It's a huge deal. And at the end of the day, this isn't just some interesting topic. It is absolutely essential. You just can't really get your head around the bigger picture of macroeconomics, from economic growth all the way to financial crises, without first understanding how this fundamental flow of money works. So I'll leave you with this to chew on. Now that you know how this all works, how do you think a country that's constantly spending more abroad than it earns, running a big trade deficit year after year, how might that eventually impact the prices you pay at the store, the kind of job you have, or even the value of your savings? It's all connected.